SoFi is a growing fintech company that is adding tons of new customers, making more profit than ever, and keeps adding more products. But this is a chart of their stock price in the past 5 years. In this video, I am going to explain why I believe SoFi could become a multi-bagger. SoFi's business model is divided into 3 segments, the first one being their lending segment, which is the biggest driver of their revenue, making $1.3 billion last year. The second is their financial services segment, which includes SoFi's mobile app, offers tons of products, and made $350 million last year. The third segment is their technology platform, composed of Galileo, a payment software they acquired in 2020, and Technisys, a cloud banking platform. With this segment, they are not only a consumer-focused business, but also a business-to-business company. It made $430 million last year. If we take a broader look at revenue, it has grown from $500 million in 2020 to $2.2 billion currently, which is an average of 42% annually. However, analysts are expecting only an average of 15% growth for the next 5 years. Regarding profit and looking at net income, they just turned profitable 2 quarters ago. Analysts are expecting them to reach 85 cents per share in 2028. If you assign a 25 PE to the company then, it would make it a $21 stock, meaning 179% returns. And I think analysts are wrong, as they have beat EPS expectations every single time. Then, in order to calculate the intrinsic value of the company, I use my Google Sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. These 3 numbers are the intrinsic value according to net income, and these 3 according to free cash flow. They mean that in order to make the desired annual return that I have put in, you need to pay these prices. I went with 15% annual return because I want to have huge returns if I decide to invest in this company. Moreover, the stock is currently trading at $7 per share, and therefore if the low assumptions occur, you're going to make a 7% annual return on your money, middle 27%, and high 42%. Therefore, if the high assumptions occur, you would get a multi-bagger in 2 years, and if you invest $1,000 in the company today, you would have $33,333 at the end of 10 years. I think my assumptions are reasonable, as I have the company growing at 12% annually on my low assumptions, 18% on the middle, and 22% on the high, having a profit margin and free cash flow margin of 10%, 20% and 30% for the next 7 years. This is the hard part about valuing SoFi because, as we have seen, they just started to become profitable. But the last 2 quarters, they already did 7% and 13%, and other established banks have around a 30% profit margin. I also assigned an 18, 20, and 22 PE and price to free cash flow to the company and left the share outstanding change at 0%. However, they have been issuing some shares, and if we assume they issue 2% of their shares annually for the next 7 years, the valuation becomes less attractive. The company is trading at a price to sales of 3. If we compare it to Palantir, another growth company with similar gross margin, it looks cheap as Palantir is trading at a price to sales of 26. The spreadsheet does not attribute any value to the balance sheet, but the company has a very good balance sheet with $4.1 billion in cash and $3 billion in debt. Regarding management, Anthony Noto is the CEO since 2018. He was the CFO of Twitter, went to Goldman Sachs after college, and became a partner in 5 years. He was also the CEO of the NFL, and I think he has done a fantastic job growing the company. However, there are some risks in investing in this company, as it is a young company that has just started to make a profit, and if we get into a recession, the growth is going to get affected substantially, as people are going to have less money to spend on their financial services. Moreover, they have been increasing the number of shares outstanding, which is very bad for investors. In conclusion, I believe it's worth investing in the company despite the risks, as it has a lot of growth potential. But remember that this is not financial advice, and you should always do your own research. I hope you found this video valuable. Let me know what you think about SoFi in the comments, and I'll see you in the next one.